Hi, this is Keith Schneider, CEO of MarketCage.com, and this is June 7th edition of Market Outlook. All right, bunch of sideways to slightly down action in the markets. Let's get into it right away. Also, don't forget to sign up for this free video newsletter by going to www.marketgauge.com and get this free every week. All right, well, market wound its way a bit down, closing just at or under the 50-day moving average in the key S&P 500 index. Let's take a look at this chart here. As you can see, I've got a pretty nice trend line. We basically penetrated the trend line, the 50-day moving average, before recovering and closing at or above those two factors. So key thing, the low and a close under the 50-day moving average and this trend line from the February lows could be significant and get some additional follow through. A couple things to note. Volume definitely picked up on the downside. You got yet another distribution day. So you've had about 3 or 4 what I would call real distribution days over the last couple of weeks. We really like to look at 5 to confirm institutional distribution. So we're sort of on the border. Now, furthermore, the ADX line on a weekly basis extremely low, meaning low volatility and very little directional movement. Taking a look at the weekly chart, here we have it. Look at this sideways action, made barely any headway. We basically closed, well, actually the high in 2014 was about 208 or so, and essentially we're basically a little less than 1% from there, or about 1% from those all-time highs that were put in and then broken, but marginally with very little headway made. So again, take a look at this bottom line here. You can see that this ADX about the lowest it's been in, I don't know, 7 to 10 years. Very, very tight compression. Now, let's go to looking at IWM. Quite a difference in performance last week. Let's go to the daily chart. And as you can see here on the daily chart, little different price action. Again, it looked like we were going to break out and really roar with this IWM, but again, more of the same. And you can see down here in terms of volume, had some pretty decent volume for a Friday. Actually, it was accumulation day. So different picture in IWM. So IWM looking like one of the stronger indices right now, closing well above the 10, the 50, and back into sort of the resistance here put in since that market made new highs about a month or a month and a half ago. So interesting divergence that the smaller cap stocks definitely doing quite a bit better than the S&P, certainly for the week. And again, strong up day on Friday, up over 0.7%, with the S&P actually down. So down 0.14 and closing weak. So what's going to happen here? Is the spiders going to follow through and follow IWM, or is the IWM going to roll over, or just more of the same sideways action? Of course, lots of interesting action in the bonds. We're going to get to that in a moment, but let's look at some of the market internals. The volatility ratio, basically holding, we had identified that somewhere in the middle of the trading range is where the market has generally found support. And even with the sell-off, we basically found support at those levels. So this is this chart here with the blue resistance and support lines, or overbought, oversold. This blue line up on top here is overbought, and when the market really gets to the 1.25 ratio, versus short-term versus long-term volatility, that's really an overbought reading. When we hit there, we sort of hit a brick wall last week or the week before, sideways action, a little bit down, but then we found support, interestingly, at that about 1.1 level, and it coincided with the 50-day moving average in that trend line. So let's keep an eye on this. Meanwhile, there's plenty of room for a downside move, and at the other end you might have found support here, looking for another up move where the market would then indicate obviously overbought sentiment readings. On an absolute basis, you can see the VIX on an absolute basis trading extremely low. So even with the bonds rising and the sort of sideways iffy action, volatility continues to drop in the markets, not so in bonds. So if we go back and take a look, you can see volatility has, now there is a pretty large tracking error, but even with that, the volatility is the lowest that we've seen in quite some time. So sentiment readings, although not extremely frothy, we like to look at the low end of the Bollinger Band, and as you can see, we hit the lower end, and basically sideways action to slightly down in the market as extreme sentiment readings at the lower end of the band push that market, push the overall market, the key indices into that sideways action as sentiment just got a little bit too frothy. So right now we're trading in the mid part of the Bollinger Band, so you got some room to the upside, room to the downside, but on an absolute level, risk tolerance is extremely high right now when read by the VXX and volatility. Let's take a look at some of the market internals. Hadn't really looked at this over the past couple of weeks because there's really not that much to say other than right now, advanced declines, you can see the breadth is getting extremely narrow. If anything, you can consider this oversold readings, but again, it can get a heck of a lot more oversold or stay dormant. Now, we're not there on the 10-day up-down volume, or the up-down volume is relatively weak as well, but not in oversold conditions. So a little bit of weakness. The market internals not that strong, and again, the McClellan oscillator, which looks out over the next couple of weeks, a little bit longer term than the 10-day, because this averages out 39 days and 19-day rate of change of the moving averages against of the advanced decline data, and you can see we're not really at any extreme. In fact, the last reading we got was back in early May. Market moved up marginally and basically worked off that oversold condition by a little bit of a pop and then sideways action. So not much to read into the breadth except that overall advanced decline getting very, very narrow. In fact, if anything, it's showing quite a bit of weakness here. Can get weaker. Would like to see a flush with up-down volume and then triggering a reverse signal, which would give us the confirmation that we like. We like to see the 10-day advanced decline, the 10-day up-down volume, and an oversold McClellan oscillator all coinciding with an upturn, but we're not there yet. So bit of pressure. I would say overall internals reading slightly negative to marginally negative. All right, let's take a look at the spiders on the calendar range. Right now, this thick line here is the 6-month, the upper end of the calendar range for January of 2015. We're trading well above it. Again, important support, and as you can see, this market has found really good support through March, April, and May, right at that 6-month calendar range. We're trading on the 1 month, so again, Overall trend is here, if you're looking at seasonals or calendar range concept of the 6 month versus the 1 month, trading a bit under the 1 month, which is a negative, but holding strongly above the 6. And if we can get beneath this 206, let's drill down on this a little bit more here. And yeah, just above the 207 level is going to be your important 6 month calendar range support. So I look at that as a pretty important support level for the S&P 500. Let's take a look at some of the global stock markets. As you can see, what is leading, what we have here is 20-week coinciding with about the 200-day moving average. And as you can see, China broke out nicely, sort of flagging, has been under a bit of pressure, but overall extremely strong. 200 that 20-week moving average pointing up. This is one of the stronger countries. In addition, let's take a look at a couple of other key countries. Germany. Okay, looking at Germany here, take a look at the weekly chart. As you can see that we actually broke out. It was looking pretty decent here early part of the year, and essentially we broke down under this rising 20-week moving average. Now you take that along with the historic rise, probably the biggest rise in interest rates. The German 10-year bond basically rose from a negative interest rate to about a 0.9 yield on the 10-year. That is pretty extraordinary, and it basically wiped out about 25 years of interest for anyone who put their money into German banks and basically got a flat to slightly negative yield. So here you have a situation where the market, clearly the stock market's breaking down under the key weekly 20-week moving average, along with interest rates rising sharply. Let's take a look at TLTs, our own bonds. Hold on one second as I switch charts here. And let's put in TLTs. And last week I had mentioned that the market had bounced off of support, which was evident on the weekly charts, ran up to the 200-day moving average along with this declining 50, and the market did sell off and actually hit new lows, which I was a bit surprised. Now, along with that German 10-year, pressure is definitely mounting on rates and the Fed to move. Economic information that came out this week was positive. Economy definitely going strong, and our bonds definitely got hit. So it'll be interesting to see what happens here. But a lot of people are calling for higher rates here. So you've got an interesting scenario where you basically closed on new lows. In fact, this is the lowest close on a weekly basis going back to October 2014, which was sort of the beginning stages of this blow off to this top that was set in the early part of 2015. Now, what I would like to do is also, let's take a look at some of that weekly chart that we were talking about. So, in terms of the weekly chart, you can see we're hitting this 200-week moving average, but closing well under the 65. So you sort of sandwich there along with that breakdown that I showed you on the daily charts that low is closed. So a lot of people, there's a big debate going on is whether the long-term trend in bonds and U.S. rates is actually over the downward move. On the other hand, you can see that you're into pretty good support here. This is the first time it's attacking the 200 weekly moving average since, let's take a look here. Oh, mid part of 2014. So that's pretty important to take notice. So if we start getting much lower than current levels, that long-term support will have been actually violated. So we are watching this 117 level in the bond market. Okay, 117 in the TLTs should offer some really good long-term support. On the other hand, with the pressure building for the Fed to raise rates here at home, uh, with the caveat that the IMF and our European brothers do not want us to raise rates. And Christine Lagarde is basically asking the United States and the Federal Reserve to hold off. So it's pretty dicey out there. It's not really clear how this is going to go. And those are your key reference points. Let's take a look at GLD. One final thing here, and as you can see, on a weekly basis, we really need to get above our short-term moving average or shorter term moving average on the weekly. I mean, that's 65 weekly moving average. That's at that 120 level or so. And right now, all you can say is still on the market. Gold is still under pressure. Obviously, very, very sensitive to interest rates. So it's going to be interesting to see if we can hold. If not, obviously the $1,000 level in gold bullion psychologically is going to be an important level to hold if things do indeed break down. Here's a picture of the silver chart. Up until earlier part of this week, uh, silver was looking pretty decent. Potential breakout above that 50-day and the 200, and it was sort of wedging itself in between there. But with the higher rates um, and bonds selling off, pressure definitely hit the silver market as well. We are at the lower end of the Bollinger Band. Hopefully that holds. Let's see what happens here. Otherwise, again, silver under pressure at the moment. We definitely want to look at just above the 16 to 1625 level for a potential reversal of this down move here. And the positive is that we are at the bottom end of the Bollinger Band, which might afford us some level of support. Okay, that's it for now. Hope you enjoyed it. Again, don't forget to sign up for this at www.marketgauge.com. Stay frosty because markets are definitely uh, all over the place. Very hard to predict the fundamentals divorced from the technicals, and watch the price action. That's your ultimate arbiter of trading, especially in these turbulent times with so much going on in terms of interest rates, the European situation with Greece, etc., etc. Thanks. Bye for now.